I have a theory. I believe we will see active small cap managers outperform in the future. ETFs are dominating our market in terms of new money flowing in, and by their need for liquidity, are restrained to larger companies. The other dominant force in our market are the super funds. And now that they are benchmarked against the ASX 300 and publicly shamed if they're too far from it, there is less of an incentive to hunt for performance and more of an incentive to hug the index. My theory is the small cap space is going to become more and more inefficient, making room for good, active managers to do well. So, to get his thoughts on my theory, I invited Rask regular Steve Johnson from Forager Funds Management to join me for a live Rask community satellite session. As this was a live session and Steve has been on the podcast a number of times, we skip the pleasantries and get straight into it. I just actually want to get your thoughts straight up. As an Aussie small cap manager, I know you manage you're involved in the global side of things too. But what I wanted to get was your point of view currently with the world being just rocked day to day by the tariffs in the US. How much do you actually focus on that? How much of your thinking or your mental capacity recently has been dedicated to that?
I have to admit, I don't know how much value it's adding, but I can't stop myself from being heavily involved in what's going on. I wake up first thing in the morning and spend the first couple of hours just reading the news about what's happened the night before and a few broker reports and things. And look, I think this is all very serious. There's some funny elements to it as well in amongst all of this tariff war.
As there always is when Trump's involved, there's going to be some humorous memes and whatnot come out of it.
He's found the mental capacity to make sure that the shower heads are releasing enough water for him to have a shower at the appropriate flow rate. There is entertaining stuff there happening, but I think it's very serious. And I think everyone actually needs to think about the businesses that they own, what this means for the businesses they own. And when I say this, that itself is hard to work out what's actually going to happen and not going to happen. But the one thing that's certain for now is that consumers and businesses in the US are very nervous, and that nervousness itself is going to have an impact on the economy. So I think that's one thing that you know already, and the rest is a bunch of hypotheses. But I think you need to be on top of this, and I think you need to be thinking about the impacts that it can have on your portfolio and the opportunities that it might create as well.
I'm curious, Steve, does that mean, have you actually made any portfolio changes other than buying on valuation grounds, like things we know last week, things certainly became cheaper than they were the previous week. Have you made any decisions based on that, on the implications of the tariffs?
In our international fund, yes. We have a business called Linamar that is a Canadian manufacturing company. Basically, it's got two arms to its business. One is auto parts, mostly sold into the US. The other is an agricultural and industrial equipment business, sold globally, but again, huge part of its business into the US. Great management team, very, very cheap valuation. It has got cheaper over the past couple of months, but we've actually reduced our weighting in that stock because the risk associated with it has gone up dramatically. And we just took a fresh look at it and said, what is the right portfolio weighting given the risks that we are facing with that business today? And we have both a maximum portfolio limit on a stock depending on its risk and a portfolio limit depending on the value that we see today. And the change for a stock like that was just, the maximum here has to go down. There is a risk here that was always there but was very, very small that is now front and center. So that's an example of a stock that we've reduced. And there's been other stuff where I think the share price reaction has been massively overdone and we've decided to up our weighting. And there's been stuff that we've taken money off the table over the past sort of 5 or 6 months that this is giving us a good opportunity, sort of exactly what we wanted. Things had run a bit too hard, took a bit of money off the table and putting a bit back on. I've talked about Catapult quite a bit recently on the podcast and think that's a good example of sometimes people really struggle to sell stocks that are doing well for them. And I always pitch it internally as to view this as you're buying yourself the capacity here to buy this stock back when it's down a bit, because nothing goes up in a straight line forever. And We've taken a bit of money off the table on Catapult, and we've been able to put a bit of that back on over the past few weeks. But I'd say in our Aussie portfolio, it hasn't been any dramatic change in portfolio weightings, and we feel like we've got a pretty famous last words, but we feel like we've got a pretty resilient portfolio there to what's happening in the world.
I don't know if you feel the same way, but I felt quite exhausted after last week. How do you specifically go about decompressing from just all of that noise and having to continuously think and reevaluate your positions?
Yeah, I had a conversation with our portfolio manager on the international fund, Harvey Magotti, over the weekend, and just said to him, I don't see this environment changing for the next 4 years. I mean, the nature of the personalities involved.
As in the whipsawing effect of big announcements, rolling them back, things like just the ad hoc nature of the man.
And then we haven't even started the impact on businesses, right? We're going to roll into this first quarter reporting season over the next couple of weeks. Most companies are presumably going to say, we don't know. We haven't seen the impact yet, and we don't know what impact it's going to have. But by the time we get to June, I think you start getting downgrades and upgrades and actual impacts on business. It's pretty easy to go, well, this company's sourcing from China and its costs are going to go up, but where else can they source from? How much can they pass through to consumers? There's a whole heap of moving parts here that are going to create an enormous level of volatility. And I think mentally you need to prepare yourself for that. I like running my marathons, and I feel like this is a bit like the first 5 or 10 Ks of a marathon. You want to get into a rhythm here of, I'm going to sleep well. I'm going to focus on the things that are important. I'm going to try and control the things that are within my control and not worry about the things that are outside my control, and make sure you're still doing the things in your life that are important in terms of that balance. For me, that's exercise, making sure I'm eating well, making sure I'm getting sleep. Is it actually going to make any difference whether you sit up all night and, watch stock prices going up and down, or are you better off waking up tomorrow morning, digesting what's happened in one go and resetting with a fresh mind?
Yeah, excellent. Now the reason why I wanted to specifically talk to you is I've had this view or this thought bubbling away in my mind about this value emerging, and this was pre the volatility that we've seen, the value emerging in the small cap space, and looking to see if it's potentially structural in what we're seeing in our Australian market. So, with the huge marketing budgets that ETFs have, the ETF issuers have, and you're seeing money pour into ETFs, a lot of new investors going into ETFs and existing investors moving into those as well, where they would have previously maybe gone into managed funds, small cap funds, picked stocks themselves. And of course, the liquidity restraints that those ETFs have, they can't really play in that small cap and micro cap space at all. Then couple that with the industry super funds, their Australian share exposure being benchmarked now against the ASX 300, and anyone who underperforms that is going to be in the headlights of it's going to be front page news with the Fin Review. Are you seeing a decoupling from? And I saw a chart from one of your reports not just before, and you can see the ASX, the All Ords, the Small Ords, really decoupling from the large cap counterparts. Are you seeing that playing out in your world where you operate?
Yeah, I'd add a third element to that too, and that's that I think funds management has become even more of a scale game than it was before. Our professional indemnity insurance, since I started this business, has gone up 7-fold. The cost of compliance, you mentioned TMD at the start of this, it's just constantly more and more.
TMDs didn't exist a few years ago. There's another.
Just more and more red tape that's added to a business, and that is all resource and its cost. And I think if you're starting a funds management business now, if you want to sell to retail, I think you are seeing people go, well, all I need here is 3 and 4 family offices, and I'm just going to have to run my business that way. But if you want to sell your product to mum and dad clients, the cost of running a business is probably 3-4 times what it was when I first started out here. So I think there's even just less active management at the really small end of the market cap range. You've got plenty of people that have got 600 million, $1 billion, but at that sort of size, you're looking to deploy 10, 20 and $30 million into a stock. You're at a size where the 100 million market caps gone. And I think what you've seen, you touched on that bifurcation. If you just look at the index, if you chop it up again into market cap ranges, the smaller the market cap, the worse the performance has been. So I think we've definitely seen that. Look, I would say we've had a really good couple of years over the past few years, and I think it is important for people to focus on what is working as well as what's not. And for me, the index side of things is a massive net good for the investment community, for people that are actually investing their money.
Yeah, for someone who walks in off the street, like Jack Bogle has created more wealth than pretty much anyone for the average person on the street by creating the index fund and having these accessible investment vehicles.
It is absolutely enormous, and it's not going to go away. And a lot of our best successes have actually benefited from some of that trend over the past few years. And I think whether you're investing at the small cap end of the market on your own or you're a fund manager, I think looking back over the past 3 years and say, okay, that there have been people out there making really good money in the small cap space, and they're identifying businesses that ultimately grow into being big enough to go into those indexes, and the returns from some of those have just been enormous. Gentrack and Catapult in our portfolio, Bravura more recently, RPM Global, they're all stocks that were 100, 200 million market cap at one point in time. They get big enough to appeal to the larger small cap managers, and then eventually into the ASX 300, and you start getting passive buying. And I think focusing on that part of the market. So can my small cap opportunity actually become something that's going to become appealing to other investors has been very profitable for us. And then I think otherwise really focusing on what's coming out of the business as well. If you've owned a company for 3 or 4 years and the share price has gone backwards, but you think that's all market and not related to the business fundamentals, then that business should be paying you fat returns. Are you getting dividends? Are you getting cash back out of it? Or is it just sitting there whinging about market sentiment towards the stock? I think there's been a lot of, when I go through and look at this really small cap end of the market, there's a lot of unprofitable, no longer growing that quickly, subscale small caps on the ASX that you just sit there and think, I don't even know that this business justifies being listed on the stock exchange.
Yeah.
It's probably, I reckon that's half. There's 2,400 companies listed on the ASX. When I go through it, there's 1,200 of them that maybe shouldn't even be listed because they're chewing up $1 million a year in board costs and listing costs, and the company's only doing 3 or 4 million of revenue, let alone profit. So how you get yourself out of that cycle, I think, is very difficult. And again, the compliance and the regulatory costs are only going in one direction.
Speaking of that, I've always wondered, do you think the Small Ords is, as a benchmark, is it a reasonable benchmark? Is it a good benchmark? Especially when I look at a small cap fund manager, I'll see they benchmark themselves against the Small Ords. And then I read their literature. And one of the first things a lot of them say is, we do not go near the resources or materials companies. And if you look at the Small Ords as an indices, there's a lot of them in there. So,
yes.
Yeah. So
we've been talking about this internally. We're about to change the benchmark on our international fund. Because it is mostly small and mid-cap stocks. Our existing client base fully understand that, but I think someone coming new to the product looks at the PDS and says, well, this is a global fund and I expect it to own the Magnificent 7 stocks, and that's never going to be the bulk of our portfolio. It never has. So we want to paint a clearer picture there on the international side of things, and we've talked about the Aussie side of things. And if you look back over 15 years, I think the Small Ords Index is 4% per annum, including dividends, versus the All Ords. The All Ords has only done 8 or 8.5. Now, I've just made the decision that if we can't do better than 8.5% per annum, just forgetting about what the index has done, then people shouldn't be paying us fees. So therefore, that All Ords is a better benchmark. And I think you're dead right about some of the problems with the Small Ordinaries Index in Australia, and maybe the index providers need to think about better ways of constructing something that is more representative of what the typical small cap fund looks like here in Australia.
I think that's important as well. If someone does attempt to, I mean, not that there's many of them, but go out there and get, say, a small cap like ETF, that's what you're getting. You're getting a lot of stuff that you would not you wouldn't look twice at.
Yeah, you're absolutely right. I think X50 or X100 is maybe a better way. Like, flip this all around. And so I'm going to start with the All Ordinaries Index and I'm going to take out the mega cap. Fair enough. But yeah, it's just not, I just wouldn't look at it. And you're right. I think if you go and buy that ETF, then you're going to get exposure to all those stocks is the problem. But yeah, that's, I think the case for active management in small caps is pretty clear cut, particularly here in Australia, but it's true globally as well. You look at the median manager on Morningstar, and it's not fantastic. It's 8% returns, but it's 4% per annum better than the index in that space. So I think if you want exposure to small caps in your own portfolio, you either need to find someone to do it or you need to do it yourself. I think buying that index has got lots of problems.
Now, Steve, what I wanted to get into is picking stocks, et cetera, talking about the portfolio. But I think we really should start at the portfolio construction level first before going into a stock specific. Because I know from listening to a lot of your podcasts, especially with Owen of late, portfolio construction's been something that has been on your mind a lot. Would you say that's probably been the biggest change recently with your investment approach?
Absolutely, yes. When I say recently, it's a 10-year period now, I'd say. I think we've talked quite publicly about some of the things that we got wrong in 17, 18, 19. So we're going back quite a while now.
It doesn't feel that long ago, does it? But
it doesn't, no.
I remember I actually saw you I've seen you on 2 roadshows. So on a second one, I think it was at the Sofitel, and that was in the dark. That was in the dark days.
I can tell you when you're trying to fix your performance record, it feels like a lot longer. And it goes back a little bit to that, the Buffett quote, "Don't ever go back to square one." I think that equally applies to blowing a big hole in your returns. It can take a really, really long time to build that back. And, for me, that portfolio management and construction piece of it is the big change. Some of the things that we got wrong, I don't actually regret buying a stock. And that sounds crazy, right? We bought a company, Freedom Insurance, that went to zero. I go back and look at the research and the framework that we had, and I think that wasn't a stupid idea. It was heavily beaten up. There was a trail book there that I thought was worth a lot of money. It's got some things in common with some investments that we made that worked out to be successful. What we got wrong was how much of the portfolio we had in that, given the risk that it had associated with it. And I think you've seen a bit of that across the small cap fund manager space over the past 12 months as well. Something worked really well. It's become a huge part of someone's portfolio and they just like the stock, keep it, and then it falls 50% and it's blowing a big hole in people's returns. So for me, really focusing on what's the right weighting. And I think there's 2 components to that are most important. We're trying to mitigate the damage of things that we get wrong first, and that means relatively small initial weightings for us. We're buying businesses that are going through trouble. Typically, we're buying businesses where the macro environment's not good. That's why people are selling the stock. Sometimes we're wrong and the market's right. My experience has been we make 3, 4, 5 times our money on the ones that work out, and sometimes we lose money on the ones that don't. And the ability to cut those ones that are not going where we thought they were going to go quickly and at relatively small portfolio weightings is important. And then the flip side of that is really aggressively upweighting stocks that are delivering the results that we thought.
You're very much focusing now on and practicing the adage of let your winners run and water the flowers and cut the weeds, so to speak. Would you say, compared to your previous your change prior to the change, now are you, when something you're thinking, hey, this thesis isn't working out as we thought, or hey, there might be something wrong here, are you cutting and then asking the questions and re-examining and saying, would we buy this again? Or are you still holding at that smaller weight so it's minimizing the impact on the portfolio?
I want to really add one important caveat to what you just said. We're not driven by share prices at all. This is, okay, I've got a piece of evidence here. So a really clear roadmap for our investment to start with. This is what we expect to happen that is different from what the market thinks today.
Mm-hmm.
All right, I've got a piece of evidence. Is it consistent with that? Better than? Worse than? If we can and we have the liquidity and it's worse than, at least cut some of it. I want the direction to be we're selling shares because we've got evidence here. Because I think as contrarians and as human beings, we don't like admitting mistakes. We don't like recognizing mistakes. The natural thing to do when you're wrong is to sit on your hands and say, I'm not going to do anything. And I say to the investment team all the time, do nothing is not the answer to the question I'm asking. If I'm forcing you to do something, is it buy more or sell? And if you really don't feel like buying more, that's telling you something about what's going on here, and we should actually be doing the opposite.
Is that a question you ask of the team regularly?
Yeah, all the time. And look, to the extent that we can cut, we are increasingly cutting and moving on. We owned SmartPay in our Aussie portfolio. We only owned it for 3 months. We had a thesis there about their business in New Zealand and how that business was going to unfold and how much money they could make out of it. Now, they came out and gave an updated presentation and said, here's how the economics are going to work. It was pretty meaningfully worse than what we had in our model. And we said, okay, let's move on. It's not what we thought it was. The share price is down 15%. We only had a small weighting in it, and we were able to exit that at some fairly modest losses there without it having an impact on overall returns at all. And on the flip side of that, we own a hospital company in the US that the share price was down 99.5% when I first stumbled across this thing. It had a market cap
of 20 million. Than that.
Well, you
can. Yes, you
What's
can.
that old adage?
Yeah.
One down 99, it can only go down one more. Not quite true. Very, very risky situation, as that share price move would tell you. A bunch of lease liabilities on the balance sheet. So we had 0.7% of our portfolio in that stock. We got a quarterly result that was good. Business had turned its profitability around, cut its costs, looked like it might trade its way out. We upped that weighting from 0.7 to 2, despite the fact that the share price had already doubled by this point. So our weighting had naturally gone to 1.4. We bought more again. We got another piece of news in January that they were getting some regulatory outcomes that were very favorable. And we ended up with 4% of our portfolio in that stock into its latest result, despite the fact that we only had a 0.7 weighting in it. So that's the other thing I've historically found difficult, because I like buying things cheap. I saw the share price at $12 when we first bought it. It's not easy to buy at 25 and 30, but that's been the big change for me, is to recognize that sometimes they're your best opportunities.
So the portfolio construction and portfolio management changes have been rolled out across, it's not just Australia specific, it's been rolled out across the Forager ethos for your international and Australian portfolios.
Yeah. And look, I think, so Alex Shevelev, portfolio manager on our Australian fund, I'd say we've built quite a bit of this organically because of what's happened over the past 7 or 8 years.
Re-examining and...
Yeah, and then Harvey Magotti, who's a portfolio manager on our international fund, he came to Forager from Balyasny, which is a big London-based hedge fund, and his job at that hedge fund was to run a fully hedged book. If he wanted to buy Airbus, he had to sell Boeing. He was not allowed to take any industry or market risk on any stock. And what he's doing with us is very, very different, and I think he's really enjoying that freedom. And there were some great investments that he wanted to buy that he lost half of his return back in the day by hedging out the other side of it. But he has brought portfolio management skills to us that we have incorporated across the business that have been very, very helpful. So a combination of different things that we've now made part of the whole Forager investment process, that just our existing products, and if we do anything into the future, it's going to be the same process around that.
Just quickly as well, back in the day, your Australian portfolio did tend to clump to value, to sectors that were undervalued. It wouldn't be that unusual for you to have, say, 15% plus into very specific sectors like mining services, etc. That would, of course, provide lumpy, volatile returns, but can provide outsized upside returns. How do you think about that now with the change in the portfolio construction, and how do you see what impact on the returns do you see from that?
But I still think owning cheap stocks is the best defense against market downturns. And when you can't find them, owning cash. When you can't find them, it's telling you something about where the market is at. So, it's not making macro calls from a macro perspective, but you end up making macro calls from a micro perspective because you can't find things that meet your investment criteria. And, this rebuilding process that I've talked about, I think 2022 was a slip up on that front for us. And that was because we held some businesses that had done very well for us that gave back some and all of that return in some cases in 2022. So I think being really disciplined about value is still very important. And the last piece of this rebuild for me is us showing our clients that we can do well in down markets. I did well in down markets, or we did well in down markets for the first 7 years of Forager's life because we owned some really cheap stocks that did well even when the market wasn't doing well. So I would like to get back to that place. And I still think those really beaten up sectors are still very important to us as a business. We own some discretionary retailers in our international fund. One business that I love there is Yeti. Australians probably quite familiar with that company. See them all over the place here. Everyone's worried about China tariffs and all the issues for that company, and they are real again, but share price is $50 down to $29 there. So that discretionary retail. JD Sports, another example, London listed, good business. We think it's got some great long-term growth prospects. That's currently very unpopular. Mining services in our Aussie fund, but I think it's for me all about a better balance in the portfolio. And I would say the better quality businesses that we own in our portfolio still at very attractive prices are companies that I just don't need the market to do anything over the next 5 years. I'm very confident those companies are going to grow and that they're going to be worth more in 5 years' time than they are today. And I think that part of both portfolios is really important. And it was actually important in the early days of our fund. We owned Macquarie Airports, we owned Spark Infrastructure, we owned ARB. And I think when we had some great returns and some success and we got a reputation for the deep value end of things, I feel like it went too far. And especially as we got bigger and liquidity became an issue into that deep value part of the market. But I'm still absolutely always looking for distressed pockets of the market.
Yeah, fair enough. Let's talk about then going to more stock-specific stuff. We do have a few questions coming through on the chat, but I'll go into these stock-specific questions. You're out and about with a friend and they mention a stock to you. I'd imagine you've got a lot of mates who are analysts and in the industry, and they say, "Hey, I've been looking at this stock. You should check it out." What are the 4 or 5 things that you look for every single time you look at a stock for the first time? And this is framed in a way that can help people who are looking. A lot of our community do like to go looking for individual stocks themselves, especially small caps. So framed in a way to help them to, with their decision framework as well. So what are the 3 or 4 key things that when you first hear about a stock, that's what you go and look at?
Well, number one, can I understand it? Is it an established business that has revenue? I'm going to need to be able to value this business at the end of the day. I might be really interested in a new business that doesn't have any revenue that's doing something really interesting. That can be fun. But for me, I need to understand it. So it's an industry and a type of business that I think I can get my head around. That's number one. And then the rest of these things are alls. If something's going to be a good idea for me, I want a pretty early understanding of why I think the market might be mispricing it now, or could misprice it.
I was going to say, does it have to be mispriced?
Yeah.
Yeah. Okay.
Yeah, that's what I do.
Yeah. That's what
I look for mispricing. Yeah. So, and I like to have a pretty good understanding of why. So that might be a business model that we've had success with in the past because people generally misunderstand them. Enterprise software has just been a wonderful sector for us. People get super pessimistic about these businesses at a very predictable point in their cycle. The gambling, Jumbo Interactive here in Australia was the first, and then we rolled that model out globally. If I come across a business where I go, okay, I've seen this before, and I know that people sometimes get it wrong, that's really interesting to me. And then I'm a bit of a sucker for price action as well. So I'm looking for something that people are currently less optimistic about. So if someone's, this business is an AI consultancy company, or it's doing this amazing stuff in AI, I know that that's going to be popular at the moment. I'm reading about that all over the place, and I go, well, that's probably not for us. It doesn't mean it's not a good investment for someone else. Someone that's got expertise in that sector might go, I love investing in themes that work, and I love finding the 1 in 20 companies that are going to crack it. That can be your specialty, and you go, this is for me. For me personally, I like going where other people are less optimistic. And so if you're an auto parts supplier at the moment to the US, I'd say, okay, I'm interested in hearing about this business. Not because it's going to be a great investment, because that sentiment gives it the potential to be unloved, underappreciated, and maybe there's something in there that we can get confident about that the market's throwing out because of the sentiment at the moment. So they're the things I'm looking for, and if I can get all of them together, then I get really excited, and if I get 1 or 2, then I'll keep digging and doing a bit more work.
So to get on your watch list, to catch your attention, the company needs to be undervalued, or the price needs to have say declined or come off, and then you start, just because your natural instincts would, you call the business forager, the natural instincts start to kick in.
Yeah.
Is that fair?
I mean, I wouldn't say it has to have come off. So that for me is a nice to have. I like the negative sentiment.
But it can go on the watch list then prior to that happening. And I wonder
it might still be cheap, right? There's no statistical evidence that stocks that have gone down do better than stocks that have gone up. It's a place where I feel comfortable, and where I find some of my best ideas is where everyone else is panicking. But I think in a market like this, go and look at the new 52-week highs and say, okay, what are the businesses that people want to buy here even when the market's getting hammered? That might be an interesting little space, but I want to have a differentiated view of something. So if I'm looking at those companies, I'm looking for a business model or something that has fundamentally changed with that business that hasn't yet fully been reflected in the share price. So I'm still looking for a differentiated insight, but it may not be driven by negative share price movements recently. And I'd say other people in our team don't feel anywhere near as comfortable with share prices that have been hammered recently, and are really good at, this is a company in a sector that I know inside out, and it's a really good management team, and I just want to own this business, and it's attractively priced because people are dramatically underestimating how well this company is going to do over the next 5 or 10 years. So it needs to stack up on a value basis, but other people in our team can come at opportunities from a different angle.
Graham here is in the chat has just asked for stocks, talk us through, you're considering then once they're attracted to you, you're looking at what? Cash flow, debt levels, like liquidity. Can you buy it? Would something sit on your watch list for a long time and you just can't buy the thing?
Yeah. I mean, there's 4 times as many of those as there are companies in the portfolio that we've got research done on. We've got a view of what we think it's worth, and we're just waiting for it to trade at a appropriate price. And if you've got, honestly, I think obviously it depends whether everyone's bullish and markets are going up or they're going down, but across a 5-year period, I reckon if you've done your work on a stock, you'll get a chance to buy 1 in 2 of them at an attractive price at some point during that 5-year cycle. It's just the natural variation of share prices. So being prepared and ready is really important. And in terms of, we value every business on a free cash flow basis. So how much cash flow is this business going to generate? Really importantly, what's going to happen to it? Are they going to reinvest it? If they're going to do that, what sort of returns are they going to earn on that reinvested capital? Are they going to pay it back to us? Are we not sure? That's a risk that would come with a particular investment. But I would say that the heuristics, it should all come back to, I think that the really complicated, detailed DCF, I built those in my time at Macquarie when we bought Sydney Airport. It was however many megabytes and 20 different sheets. And I think there's a level of precision about those things that can frankly be quite dangerous. We are valuing every single business on how much cash that business is going to generate over its lifetime, but the range of potential outcomes there is hugely wide, and it should all boil back to a pretty simple, the old PE ratio, or a PE ratio a few years out if you think that's going to change dramatically, or some sort of free cash flow yield that just makes logical, intuitive sense at a high level, as well as, okay, for me, the models are a bit more of a roadmap for how we expect it to unfold, and they are a very specific valuation tool.
Love to hear your thoughts on management as well, and how much the quality of management comes into play in your assessment of a business. It's interesting as well because a deeply undervalued stock, or a stock that's, say, been through some troubled times, might not have the same management in place that took it there. Are you in the small cap land, in stock pickers land? It's almost become a cliche of the founder and the founder investing alongside founders. How do you view that?
And look, it's been a bit of it's maybe a healthy thing. I think that the past sort of 12 months has been a minefield, really, for
had a bit
of
a correction on that founder story with some very notable.
PWR, there's a lot of companies where their share price, and maybe the best of them is Johns Lyng, in terms of having a reputation for being a wonderful management team and people being willing to pay a really high multiple of earnings for that company. To, I think one of the brokers called them John's lying the other day or something. So that was the broker that IPO'd the company. It's been a dramatic reversal in management reputation there at that company. So I think it's important for everyone to realize that is an estimate, the same as everything else is an estimate. My current estimate is that this is a great management team, and be willing to change your mind if you get evidence that that's not right. And my experience has been, when people take a lot of money off the table, it just changes that dynamic in terms of alignment. And they can still have, tens, hundreds of millions of dollars in the business, but if you've taken 60 or 70 out, it's enough money for you not to
There's a saying,
having your whole life just dependent on this company. It's a different approach. And I would say, like everything else about a business, just identifying good management is not going to make you money. I think you need to identify underappreciated management, and that it's not in the share price, that these people are good at what they do and they're going to execute over time. And, we've had examples, Bravura maybe being a great one, of management teams coming into an underperforming business and doing a wonderful job of turning it around. So it's not easy, but it is very important.
Yeah, it's potentially be a red flag. Is something to be wary of, is where the founder story, the management story, etc., is baked in thoroughly into the investment case, where it's that's where you're backing a revolutionary kind of manager, a rock star kind of manager.
Yeah.
Tell us a bit more about a couple of other red flags. What do you see as a red flag? So I kind of get the feeling that your red flags might be what other people might see as positive signs.
Yeah. Number one for me is rapid acquisitions. And particularly in the US, we own some just great businesses over there where the model is to go and buy.
Lots of people be familiar in Australia with roll-up stories.
Yes.
There's quite a lot of growth stories that are purely roll-ups. Is that what you're referring to when you?
Yep. Absolutely. It's a very, very dangerous space, and I think particularly if you start seeing the acquisitions get larger and larger, I start worrying more and more. If it's a small percentage of revenue and the case there is really strong in terms of we take the costs out and we add this in, if it starts going international, if it starts being not exactly like the business that they've got at the moment, it's not for a moment to say that it can't work, but for me, it's a space that I feel deeply uncomfortable with. I would just rather internal organic opportunities, or, lots of tiny little acquisitions that are, if it all adds up to less than 10% of a company's revenue a year, and you've got a management team that has the skill to do that, then fine. But when you start doing big ones, that really worries me. And then the cash flow statement for me is one of the first things I go to. So you're seeing a lot these days of capitalized expenses. So you've got a business that's reporting these great management EBITDA numbers, and you've got stock-based compensation, and you've got capitalized tech development costs. Sometimes in a business where that's their business, they're saying this is not an expense when it's 20% of your revenue base and a core part of what you do. You're a software company. To be not counting software development expenses as a cost is crazy. So I like to see good cash flow conversion. Now, it's not that was bad this year, therefore I'm not going to buy the stock. But over a 4 or 5 year period, I really like to see the cash flow add up to the profits that the company says it's making.
Yeah, it tells a story, doesn't it? Absolutely. So a quick question came through actually. Do you guys participate in a lot of capital raises?
A few. Yeah. All here in Australia.
Mm-hmm.
But I don't like the way that it happens here in Australia. There's a lot of friendly placements going to funds managers, but we've formed the conclusion that our clients might as well be benefiting from that as someone else's. So we do participate in some of those cap raises, and we do help companies that we own try and fix their balance sheet sometimes. Sometimes part of the opportunity we identify is this is actually a business that could perform much better if it didn't have the capital structure that it has. Could we do something about that? So it's a small part of what we do, but we do it pretty regularly, if that makes any sense.
Yeah, cool. I just want to touch on a couple of companies in the portfolio, and then I've got a few questions that have been coming through. Can I get the elevator pitch on? I'm interested in Praemium. I've previously been a Praemium customer and used it some years ago, so I'm interested in your view there, and NZX as well. I noticed both of those, and NZX is not something that I've looked at too closely at all. So if we can grab your views on those two portfolio stocks, or anything else as well that you think that people should know about.
Sure, I'll start with the latter because it's a pretty easy one. I mean, it is what it sounds like.
I'm guessing, is it the New Zealand Stock Exchange?
It's listed on itself. And that's a pretty moribund stock exchange. Most of the successful companies in New Zealand move their listing to Australia or even to the US.
Yeah, if you're downtown in Auckland and you're at, is it Brito Mart, you can probably watch the entire NZ Stock Exchange ticker code go around in about 4 minutes.
Pretty much. So on that front, it's not going to grow a lot, but it has over the past sort of 18 months been depressed just in terms of volumes because of the recession that they've had in New Zealand. So we're not expecting it to grow, but it's been under earning relative to what we think it will earn on average. But the kicker about the business there is they are the largest provider of index funds in New Zealand. So they have an index fund business there, which is growing really nicely. And then they have built their own hub, NetWealth Praemium sort of equivalent, a platform for financial advisors to run their business on. And that part of the business is growing quite rapidly as well, and has a nice pipeline there of clients that are still to be brought onto that platform to help it grow. So the opportunity for us there from an investment perspective is you've got this boring stock exchange, it's under earning a bit, it's the cash flow and yield that you're going to earn, but there's a growth engine here that's actually becoming quite meaningful and is going to start driving the overall company growth levels from here on. And there are a couple of businesses with some really nice tailwinds behind them.
That surprised me a lot about the New Zealand market, that the ETF opportunities that Australian investors have here. It's a very different world over there in the opportunities that they have available to them.
Most Kiwi investors I know though own ASX listed things as well. They can buy every ETF that's listed on the ASX pretty easily as well. It's, I don't think it's that difficult for them, but I think being the local provider of these things just helps a little bit in terms of it's a bit more tax efficient, and there's reasons why you would want to do that. So they're not managing these products themselves. They're sort of white labeling them things and offering them through the exchange. And I don't see any reason why they won't end up with a similar suite of products to what we have here.
So Praemium, tell us about Praemium and how it came to be in a portfolio.
The share price got hammered is the short way of why it ended up in the portfolio. Look, this is the third platform business in Australia. I think it's pretty obvious.
Yeah, well, we've got, comparing it to, say, a lot of people will be familiar with Hub. A lot of people will be familiar with Netwealth. These have been terrific success stories. Yeah.
So what has made them a success? It's a massive scale business, right? You've seen as those businesses have grown, the drop through to profitability has been wonderful. There's more advisors coming on. Each advisor is putting more and more of their clients on. It's just been this really nice growth algorithm in what your costs, they've maybe been a bit less fixed than I would have assumed, to be honest with you, but your costs are relatively fixed, right? Once you've built the infrastructure here, you add the revenue. So the third player is never going to be anywhere near as profitable as the first and second player for exactly those reasons. But we still think that there's plenty of space for a third player in the market. So Hub has some technical features that Hub and Netwealth don't do as well, particularly appealing to really high net worth advisors. So people who want to own unlisted assets and private equity, there's a bit more flexibility around the Praemium platform. And it has been growing quite nicely, but because it is smaller, it doesn't have the same scale advantages. And when something costs only need to go up a couple of $1 million and all of a sudden you've knocked 20 and 30% off your earnings. And that's what happened 18 months ago. Now they came out sort of post-COVID and said, we've got to put through some pretty big wage increases here. Our cost base is going to be up 10% and revenue is not going to be up as much as that. So the earnings were dramatically less than the market had anticipated. We're willing to stomach that volatility. And I think at its core, it is still a growing third player there and it has a reason to exist. And it probably gets bought at some point by someone who wants an international player probably or a private equity company who wants to build that third player. So we're really happy with how that's going. The last few quarterly results there have been pretty good. That's reflected in a share price that's run up from 40 to, it was 80 pre the previous results. It's come back a bit since then, probably not surprising, but we're pretty happy with the business progress. And it's one of those companies that we've sort of gone tick on the thesis and added a little bit to our weighting, although it, because it had run up so much in price, the weighting was up naturally as well.
Steve, I'm going to jump into a couple of these questions, but I do always ask, always, I've asked it once, so I've only done one of these satellite sessions, is the Forager funds, if someone is out there holding a high growth, or balanced style, diversified portfolio, how does a Forager fund slot in alongside one of those?
Well, we want to be people's small cap exposure. Our mandate is to buy unloved and underappreciated, but there's a lot more of those at the small end of the market than the big end of the market. So, if you're sitting there and you're saying, okay, I've got my fill of big blue chip stocks around the world and I'm doing that pretty low cost, there's an opportunity here. And I think it's a particularly good opportunity at the moment because the starting valuations are relatively low for me to have 10 to 20% of my portfolio in small caps. That's what our TMD says, 10 to 20% of someone's portfolio in both of our funds as a maximum. And I would say that sort of weighting is probably the right weighting for your small cap exposure, full stop. So if you're spreading that amongst multiple people, then that means less for us. But we want to be that part of your portfolio. I think small caps do well over the next 5 to 10 years relative to large caps. And it's our job to do better than that as well and add some value to your portfolio through small cap plus the benefits of active management with us.
Awesome. Let's now jump into a couple of these quick questions. Trent has asked, managing both a global and Aussie fund, where are you more excited about when it comes to small caps? The global or the Aussie?
I don't really have an answer to that, to be honest.
Love your children equally, but
well, I've been surprised how. I mean, it's come at different times, but the returns have been surprisingly consistent, and maybe that comes back to the framework for the business. Across both funds, we are looking for companies that are going to give us long-term returns of 12 to 20% or 20 plus, depending on how risky they are. So if it's a really high quality business with a great balance sheet, lots of liquidity, we can buy something that's at that 12 to 13 end of the range. If it's something that comes with more risk and is smaller cap, then we want the higher end of that range. And both funds have ended up delivering results pre-fees that are pretty consistent with that. I feel like we're seeing the ball really, really well here in Australia at the moment. I touched on that dynamic around identifying these companies that are growing enough. We're having some great successes there. I think the Aussie market is particularly, that dynamic around valuations is as big here as it is globally. Obviously, it's smaller. We sat down. I sat down with one of the analysts this morning and just did a quick filter of the US market for stocks that meet the same criteria that we're looking for here in Australia, and there's 10 times as many of them.
And they've been quite large, wouldn't they? Would they be, comparatively speaking, market cap wise?
Yeah, I mean, the average market cap in our international fund, the median would be closer to 4 to 5 billion versus probably 400 million in our Aussie portfolio. That's the magnitude of the difference. I would like us to be doing a bit more in that international portfolio at the sub 1 billion market cap range, though. I think it's something we can do as a fund manager that lots of our competitors can't. A lot of the product in Australia is, when they say small to mid, it's a lot of mid and a lot less small. And I think the inefficiencies in the market are still greater the further you go down that market cap range. So I think people should expect that part of our portfolio to grow over time. And like any of these market downturns, there are a lot of stocks out there at the moment that are down 60 and 70% over the past 6 months versus a market that's down 10 or whatever the number is. So I think there's a pretty good opportunity at the moment to be identifying some of those differentiated ideas that can, report a couple of good results and do well even in a difficult market, I think.
And we've got a quick one here on tariffs. We spoke about the potential negative impacts that we're seeing on some stocks. Not too much talk about the winners or some positive outcomes for them. So do you see any stocks that may be winners from the tariff situation?
Yes.
Or is it still a bit too hard to see because we haven't really seen the second and third order effects?
I mean, we've been looking, we don't own this stock. We've been looking at a company like FTI Consulting. They do bankruptcy advisory. And so thinking about what companies are going to do well in a general economic slowdown. We have recently added a stock to our portfolio that does, manufacturing capacity additions they are exposed to in the US. So to the extent that manufacturing does come back onshore over there, then that company is pretty well placed to do well by that. I still think it's really, really uncertain at the moment. With the companies that I talk to, nobody is standing there saying, okay, I'm now going to invest all my money in building manufacturing in the US, because it's been so haphazard that imagine you commit to a whole heap of spending and then you turn around in 2 years' time and your competitors haven't done it and they're sourcing from China tariff-free and you're paying US wages to build something. So I think it's still very uncertain at the moment. Look, I think if just from a fundamental perspective, you've had the NASDAQ down dramatically more than say the S&P 500 or the Dow Jones Industrial Average. It was up a lot more. It was a lot more expensive. I think there's, it's a reversal of momentum, which I think is really healthy. They're also probably the businesses that are least affected by economic cycles and tariffs, and you've got a bunch of technology companies in there, a lot of them that have recurring revenues. So, I look at our Aussie portfolio, again, a lot of them were up a lot prior to this, but Catapult's down 20% or so over the past couple of months. I don't see this having a meaningful impact on that business at all. I think the sport space is going to be pretty resilient. Their revenue is recurring. they've got a little bit of cogs that maybe there's tiny amount of tariffs on, but it's a small fraction of the business there. So there's companies that are going to benefit, and then there's also, I think, unfairly punished companies that are not going to do that much worse in this environment.
Awesome. Steve, I really appreciate taking the time out of your day to sit here with us and answer a few questions. Thanks for joining us, mate. It's been great.
Thanks for having me on, and I hope everyone enjoyed it.
Excellent. Cheers, mate. Thanks, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.